UK Bank Withdrawal Rules 2025. What pensioners must know before December. Welcome to State Pension Update. If you're over 60 or managing a loved one's pension, this is your go-to source for the latest updates on DWP, HMRC, and all UK pension-related news. Today, we're diving into the critical bank withdrawal rule changes coming this December 2025, explaining what you need to know to keep your money safe, accessible, and in your control. Millions of pensioners across the UK are facing a major change that could affect how they access their own money. Starting December 2025, new bank withdrawal rules are coming into effect, and they could limit daily cash withdrawals, introduce stricter ID checks, and even delay access to your pension payments. For many over 60s, this isn't just inconvenient. It could be a serious threat to financial independence. With rising fraud and digital banking shifts, the government and banks say these rules are necessary for security, but critics argue they punish ordinary pensioners while doing little to stop real criminals. From rural residents struggling with fewer branches to those who rely on weekly cash for budgeting, these new policies could create unexpected challenges. In this video, we break down exactly what is changing, why it matters, and most importantly, what steps you can take to protect your money and maintain control over your finances. Don't miss this. Your pension and access to cash could depend on it. Welcome back to the State Pension Update. Across the United Kingdom, a quiet but profound shift is unfolding in the banking sector, one that is causing unease among millions of pensioners. As of December 2025, new bank withdrawal rules are set to take effect, and they could significantly change how people over the age of 60 access their money. These are not just minor policy tweaks. They represent a fundamental rethinking of how banks interact with customers, particularly older adults who rely on traditional cash withdrawals and in-person services. From daily cash withdrawal limits to stricter ID verification checks and even new reporting requirements for transactions deemed unusual, major banks are implementing these changes in line with government guidance aimed at reducing fraud and money laundering. On paper, these measures are designed to protect customers, but behind the official explanations lies a growing fear among pensioners. Many worry that these policies could make it harder to access their own money, delay Department for Work and Pensions payments, or even trigger unnecessary investigations into ordinary, everyday transactions. Today, we are taking an in-depth look at what these changes mean, why they are being introduced, and most importantly, how they could affect your bank account, pension payments, and financial independence in the months ahead. The first question many people are asking is, why are UK banks making these changes now? According to regulators, the updates are part of a nationwide effort to modernize banking security and align with international anti-fraud standards. While this sounds like a sensible goal, the timing and scope of these new rules have caused frustration among pensioners, many of whom rely on cash to manage their daily expenses. Several factors are driving these changes. There has been a noticeable rise in banking fraud targeting pensioners, with losses exceeding £580 million in 2024 alone. At the same time, there is growing reliance on digital transactions, which has inadvertently created gaps in security for those who remain cash-focused. The government has also been putting pressure on banks to monitor high-value or unusual withdrawals more closely. Critics, however, argue that these rules punish the vast majority of law-abiding customers, while doing little to stop determined criminals. For pensioners who have used cash for decades as a tool for budgeting and independence, these changes mark the beginning of a worrying new era of financial oversight. So, what exactly are the new withdrawal rules? Major banks including Barclays, Lloyds, HSBC, and NatWest have begun rolling out updated guidelines, and they contain several key measures that all customers, especially older adults, should understand. One of the most immediate changes is the introduction of daily or weekly cash withdrawal limits. Previously, customers could withdraw up to £1,000 in a single day, but some banks are now lowering this threshold to as little as £300 or £500 per day for standard accounts. This means that larger cash withdrawals will require advance notice, often 24 hours, or digital confirmation through an app or phone call. While this step is designed to reduce fraud risk, it can be daunting for pensioners who may not use smartphones or online banking regularly. Another change involves enhanced ID checks. Banks may now request photo identification or secondary proof of identity, even for relatively small in-branch withdrawals, particularly if the customer makes frequent transactions or handles multiple pension deposits. This rule, while intended to prevent fraud, adds extra friction for older adults who may not carry up-to-date ID or may struggle with the bureaucratic process of verification. Transaction monitoring will also become stricter. Any withdrawal above £1,000 could trigger an automatic review or require staff approval, and unusual activity could result in temporary account freezes until verification is complete. These measures aim to protect customers, but for those with mobility challenges or limited access to digital services, they may result in real inconvenience, delays, or even financial exclusion. Pensioners are particularly vulnerable because many still rely on cash for daily budgeting. For decades, withdrawing weekly sums of money for groceries, utilities, and social activities has been the norm. Now, those routines are being quietly restricted, leaving older adults facing new hurdles that younger, digitally savvy customers may not even notice. Pension advocacy groups have raised concerns about this shift, emphasizing the increased reliance on digital banking, confusion over new ID requirements, reduced access to ATMs and physical branches, especially in rural areas, and the heightened risk of exclusion and vulnerability to scams. The changes to daily cash limits are among the most immediately noticeable. While some banks currently allow withdrawals of £500 to £1,000 per day, these limits are being tightened to £300 to £500 per day in late 2025. For larger sums, customers may need to give advance notice, navigate digital verification steps, or even risk triggering a fraud review. For many pensioners, this feels like a significant loss of control, a creeping restriction on access to their own money. Similarly, new mandatory ID verification requirements could create further complications. Banks now may ask for a passport, driver's license, or other forms of identification, even for routine transactions. Outdated or missing ID could result in a withdrawal being denied, causing unnecessary stress and disruption to pensioners' financial routines. Rural communities are likely to be hit hardest. Over 5,000 bank branches have closed across the UK since 2015, leaving older adults in small towns or villages dependent on a few local branches or post offices. With fewer ATMs and longer travel distances, stricter withdrawal rules and enhanced ID checks are expected to cause delays and confusion. Experts warn that without dedicated support, older customers in these areas may struggle to adapt, potentially creating a new form of financial isolation. DWP pension and benefit payments are another area of concern. While the DWP is not changing its payment schedule, banks' stricter policies could delay access to funds. In cases where automatic fraud filters are triggered, pensioners could find their accounts temporarily frozen until verification is complete. This poses a real risk for those relying on timely access to state pension, pension credit, attendance allowance, or personal independence payment, PIP. Even if payments arrive on time from the DWP, new bank policies could create unexpected barriers to using that money. The government supports these changes, citing the protection of vulnerable customers against scams and identity theft. Regulators like the Financial Conduct Authority and HM Treasury argue that banks must take proactive steps to safeguard pensioners. Consumer groups, however, argue the opposite, that these measures are excessive, invasive, and restrictive, limiting personal freedom in the name of safety. The ongoing shift toward a cashless society is also viewed as an underlying motivation, with cash transactions in the UK having dropped by 40% over the past 3 years and the trend accelerating. So, what should pensioners do if they face withdrawal issues? Experts recommend contacting the bank immediately, asking for the specific reason for any restriction, and escalating the matter to a branch manager if needed. Documenting all interactions, including reference numbers and staff names, is critical. If problems persist, filing a complaint with the Financial Ombudsman may be necessary. It is also wise for pensioners to maintain a small emergency cash reserve at home, keep ID documents up to date, and notify their bank in advance of any large withdrawals. At its core, this story is about financial freedom and independence. The ability to access your own money when and how you choose is fundamental to autonomy and dignity. As banking rules tighten, pensioners must adapt quickly, stay informed, and take proactive steps to protect their finances. Reviewing bank withdrawal policies, setting up alerts for unusual activity, safeguarding personal ID and card details, and staying connected to reliable information sources like the State Pension Update are all essential strategies. The message is clear. The UK's new bank withdrawal rules may appear as routine policy updates, but for millions of over 60s, they represent a turning point in personal finance. As the nation moves toward a largely cashless economy, pensioners must remain vigilant, informed, and assertive about their rights to fair and accessible banking. This isn't just about cash, it's about trust, autonomy, and respect for the generations who helped build the country's economy. Staying alert and proactive is now more important than ever, and for those who do, financial confidence can be maintained even in this new, challenging landscape. If you found this breakdown useful, subscribe to State Pension Update for ongoing coverage of crucial updates on DWP policies, HMRC pensions, and the latest in UK financial regulations. These new rules may feel overwhelming, but staying informed and proactive is your strongest defense. Make sure your ID documents are up to date, plan ahead for larger withdrawals, and keep in touch with your bank to avoid delays. For pensioners, knowledge truly is power. Understanding these changes now can prevent frustration, missed payments, or unnecessary account freezes in the months ahead. At State Pension Update, we're committed to bringing you clear, actionable guidance on pensions, benefits, and financial policy in the UK. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you never miss an important update that could impact your money and independence. Your financial freedom matters, and we're here to make sure you stay informed every step of the way.